Hi everyone, this is our MAE 298 final project presentation. I'm Taiga and my groupmate Howard. We both worked on Bayesian stock portfolio optimization. So the background and motivation. So in MAE 298, we took Bayesian analysis in the context of engineering in general, but we also wanted to extend this to see how it plays out in something outside of engineering like finance. And through this project, we found that Bayesian analysis is actually widely used in finance and prediction of risk management of assets. And Bayesian methods provide superior prediction compared to traditional methods because we're able to define a prior and then keep on updating with new data. So given the time scope of our project, we decided that we wanted to build a financial tool that can quantify the risk of stocks using Bayesian analysis. We also wanted to extend this risk quantification to optimize a stock of or a portfolio of stocks to minimize risk and maximize returns. So here, our key deliverables would be the value of risk or VAR and portfolio optimization. So first, I'd like to start with value at risk, which quantifies the risk of stocks. So what is VAR? Well, VAR is a widely used risk metric in banks and other financial institutions for investment, risk management, and regulatory controls of financial institutions. VAR measures the probability that a stock or portfolio will lose more than a certain amount. So, as an example, if I say a 5% daily VAR of negative 2%, that means that there is a 5% chance that the stock will lose more than 2% in a day. And you can see this visualized on the image here on the right. So in this image, the orange bars correspond to the 5 percentile. And so for this case, there's the 5% VAR for this would be negative 4%. To estimate VAR, traditional estimations have been used, such as historical VAR, parametric VAR, and Monte Carlo VAR. All of these traditional VAR estimation methods, however, have their own drawbacks and fail to capture market shocks and fat tails effectively that Bayesian VAR does better. So going into the details of each of the estimation or the traditional estimation methods of VAR, historical VAR is one of the most easiest ones to visualize. You take the actual historic return data without assuming distribution and then just line it out and take the fifth percentile to get the 5% VAR. A weakness of this is one of it is that you need historical data, and sometimes that's not available, or at least available to uh, the duration that you would want. And another weakness is that this approach always assumes that the future will behave within the past realm of the past data. Another approach is to use a parametric VAR. This one assumes that the returns follow a known parametric distribution, so that can be something like a normal distribution. And then you take the 5 percentile to calculate the 5% VAR. A weakness of this is that the distribution is static, and because it assumes the static distribution, it might have poor performance during high volatility periods that are pretty common for stocks. The third method is to use Monte Carlo. So I'm sure a lot of you are familiar with the Monte Carlo method. It's like throwing darts onto a dartboard. You sample a large number of potential prices using a model, and then you take these results, line them up, and then take the fifth percentile if you wanted to calculate the 5% VAR. A weakness of this approach is that it is sensitive to the model assumptions and parameters, and it also is computationally uh, expensive. The fourth approach, which is the approach that we took, is the Bayesian VAR. This one models returns using a Bayesian framework. So we have our prior beliefs, and Then we update it with each of the observed data using Bayes' theorem. The use cases of Bayesian VAR are for risk estimation in rapidly changing markets that require dynamic updates, and also in cases where historic data is limited or unreliable. In this case, we can also use partial pooling to get influence from the broader market if we don't have enough data. So going more into detail about the methodology for implementing Bayesian VAR. So just like the football simulation problem, we have to first define the prior distribution. And for our case, we used the student's t-distribution so that we would need the mean variance and the degrees of freedom. Then we update with the new data using Bayes' theorem. And then we use the Markov chain Monte Carlo or MCMC to sample future returns from the posterior. Finally, we'd calculate the VAR. And for our purposes, we computed the 5% VAR for a 5-day period. And a key point of this approach that sets it apart from the historic traditional VAR estimation methods is that it looks at uncertainty both from the randomness in the returns and also the uncertainty in the model parameters. Now with this in place, for the implementation, we first needed to collect the historical stock and market returns, then perform the Bayesian analysis, and then thirdly, we compared the results between individual stocks to see how they compare. Data collection was not that hard. There's a lot of public websites that contain stock data. We took one from a website called investing.com just because it was pretty convenient. And we utilized the change percent, which you see highlighted in the red box, which is the daily returns of the stock. For our purposes, we used 5 years of data from February 2020 to February of 2025. And for the stocks examined, we looked at the S&P 500 for the broader market, and then Apple, Boeing, Lockheed Martin, and Starbucks for individual stocks. Now, this is the Bayesian model definition. So I'm going to talk about the justification of the priors in the next slides, but for the distribution of individual stock returns, we went with a student t-distribution. We did some research and we found that in the literature that the student t-distribution performs superior to the normal distribution, and it's a widely used distribution to model stock returns. The student t-distribution is just like the normal distribution in that it has the mean and variance, but it also has a third parameter nu, which affects the tails of the distribution. We also have incorporate the market effect using this beta term. And for the initial prior distribution, for mu, use the normal distribution uh, centered on the mean of the historical data as the initial prior. For sigma, we use the half normal distribution using, again, a standard deviation of the historical data. And then we also used gamma distribution for nu. Now, a half normal distribution is just a normal distribution that is that has the negative part negated. And for the beta value, we use the normal distribution centered at 1. Now, talking about the rationale of why we chose these priors. So again, as I mentioned, the student's t-distribution has fat tails, which are able to incorporate more extreme events in the financial markets than what a normal distribution can do. And with our Bayesian approach, we can allow nu to be learned from the data, which improves the model robustness. For the other parameters, there wasn't much in the literature that explained what was the best hyperparameters, but we used a gamma distribution for nu on the assumption, or because it ensures positivity and allows flexibility in capturing tail behavior. We used a normal distribution for beta centered on 1, which we reasonably assume that the stock correlates with the market, and a half normal distribution for sigma because we believe that we wanted non-negative values, but we still believe that smaller volatilities are more probable compared to larger ones. In terms of the partial pooling or where the beta term came from, it comes from this capital asset pricing model or CAPM relationship, which states that the expected return of investment is the return of the stock plus the influence from the broader market. And for our purposes, we use the S&P 500 data as to model the broader market. And in essence, if your beta value of a stock is larger than one, it means that it is more volatile than the broader market. And if your beta value is less than one, it means that your stock is more stable or less volatile than the broader market. So now we jump into the results. So this is an example for one stock, Apple. You can see on the top right, we have the Apple stock returns and the S&P 500 returns. And using a MCMC with 4 chains and 5,000 samples, and 1,000 simulations on the posterior predictive distribution to compute the VAR, we found that the 5% VAR for a 5-day period was negative 4.57%. Again, this means that there is a 5% chance that within the next 5 days that Apple's stock will drop more than 4.57%. From the MCMC, we can see the obtained values for mu, beta, nu, and sigma. Similar analyses were done with Boeing, Lockheed Martin, Starbucks, and you can see the results here. I've tabulated them in the next slide, and we can talk about the results. So this is the tabulated results of the VAR values. First, we have Apple, which had a VAR of negative 4.57%. Out of these four stocks, we can reasonably assume that Apple is the most well-performing stock with high profits and stability and brand recognition. And you can see that that is reflected in the mu value that's positive here for the T distribution. And you can also see that it has a beta value of 1.2, which means that it is a little bit more volatile than the broader market. And this is understandable because Apple is a tech stock, but also it's established enough that it's not too volatile. Next up, we have Boeing, which has a 5% VAR of negative 9.04%. This performed the worst out of these four stocks, and that is pretty understandable if you looked visually at the stock prices between the 5 years that we sampled. And that is reflected in a large negative mu value or a relatively larger negative mu value. And also, it's reflected in the beta term or for volatility. Now, Boeing is a large defense contractor and also has a duopoly on airplanes with Airbus. So you'd expect its beta value to be less than one because it would be less volatile than the broader market. But because of the poor decisions and accidents with the 737 MAX and cost overruns on SLS, that might be contributing to the volatility of Boeing stocks and also contributing to why the VAR value is so low. A third stock that we looked at was Lockheed Martin. This is a defense contractor that hasn't had major scandals and it has been steadily rising. You can see that the beta value is 0.43, which reflects a large defense contractor, which is less volatile than the broader market. And it had a 5% VAR of negative 5.56%. Finally, we looked at Starbucks as another example of a stock that hasn't been doing too well, but in a different industry. And we found that its beta value was around 0.94, but it also had a 5% VAR of negative 5.42%, which is comparable to Lockheed Martin. And I was a little surprised by this, but then this might be due to the broader market doing better, at least in the February timeframe when we predicted these results. And that might have contributed to the 5% VAR value doing comparable to Lockheed Martin. So with this, I'd like to pass it on to Howard, who will be explaining portfolio optimization.
Hi everyone, this is Howard, and next we'll be doing our portfolio optimization where we will use our previous model to determine the best stock weights that balance return and risk. So the objective is to use the model that we computed previously and extend that. We will be using an entire portfolio of stocks. For our for our project, we'll be using a portfolio size of 3. This will make sure that the complexity of our model isn't too high while 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 making sure that our modeling and optimization is robust enough to handle multiple stocks. So the difference between this and the previous iteration is that our student t distribution, instead of being scalar, will be multivariate. This adds complexity because there's now an additional goal of determining the correlation matrix. This will define the deviations of each stocks, but also the standard deviations of the stocks in correlation with each other. And here's our updated Bayesian VAR methodology. As stated previously, we'll be defining a new amount of stocks in our portfolio. From that, we'll, we'll be defining our prior distribution for the mean, variance, and degrees of freedom for each stock. Importantly, we'll be defining a prior for the covariance matrix. After that, we update our prior with new data, and then with our posterior distributions, we'll be simulating future returns with a Markov chain Monte Carlo method to sample future returns. Finally, we'll be calculating the VAR of each stock in our portfolio, and then use those VARs to optimize for portfolio weights that maximize returns for a given risk tolerance. Our Bayesian model definition is similar to before. The likelihood will be the market effect of beta times mean of the market returns. This beta will be a normal distribution with mean 0 and standard deviation 1. This incorporates partial pooling into our project. Note that we use the mean in this case because this helps reduce computational complexity and helps reduce noise the of day-to-day variances in the market. Next, we define the likelihood as the multivariate student t distribution. The priors for this will be mu, which is the normal of the historical data of each stock and the standard deviation of each stock. Gamma will be defined with an alpha of 2 and beta of 0.1. Similar to before, and the important distinction is the covariance matrix. This will be defined as an LKJ prior, and we'll go more in depth in the next slide. But for this, the sigma will be a half normal distribution, which aligns with our prior assumption that the correlation of each stock and the standard deviation will be small. Next, we'll define the covariance matrix and explain our LKJ prior. In short, the LKJ prior controls the distribution of the correlation matrix. As seen in the equation at the bottom, we can define our prior eta, and with higher eta, it means that there's weaker correlation, while a smaller eta means that there are stronger correlations. In our project, we'll be assuming that the correlation between each stock will be small. Next, optimization will be done using our posterior distributions. This will be use of the Skippy optimization package. It will simply maximize returns of our portfolio for a given weight. And the constraint is that the VAR must be below a specified threshold. From this constraint, we could assume that higher risk stocks of a higher VAR will be less weighted if we can tolerate low risk. And if we can tolerate higher risk, then will be it our portfolio should have more of high risk stocks. So that's what we'll be attempting to see in our results. Here's the first set of results. So for this portfolio, we have Apple, LMT, and Intel. Similar to before, we use a Markov chain Monte Carlo with 4 chains and 5,000 samples. And from those procedures, we'll be making 1,000 simulations to average over to determine our VARs and returns. From the modeling, we see the posterior distributions of mu, beta, and mu. Importantly, we note that in mu, the mu graph, um, which represents the mean distribution of each stock, we see that Apple has a higher mean, indicating that it has higher returns on average compared to the other stocks, with Intel having a low mean and low mean, and also we look at the VAR for each stock, calculated from the simulations of the future. We see that Apple has a high VAR, indicating that that is more volatile. LMT has a low VAR, while Intel has a high VAR, indicating that it has high risk. Because Intel has a combination of low returns and high risk, we expect to see very low Intel um, in our portfolio optimization. Finally, we note that the covariance matrix has high values on the diagonals, indicating more correlation and standard deviation for each stock for itself, but very little cross correlation from each stock to each other. This matches our assumed prior that there's little correlation between each stock. Next is the results of the optimization equations. And here we see for stock 1 that represents Apple, stock 2 that represents LMT, and stock 3 that represents Intel. Um, there, the 5% VAR of -5% skews more towards LMT. This is because LMT has a lower VAR, indicating that there should be more of that if we can tolerate less risk. For higher risk, we see a higher percent of Apple in our portfolio, and this indicates that our optimization works well because while Apple has high returns, it has higher volatility than LMT. So if we can stomach the volatility, it means that we should invest more in Apple. Intel remains at a low value for each portfolio. Nullity is non-zero, and this is likely due to the covariance matrix that indicates the correlation between each stock in our portfolio. Because it is correlated to the other stocks, if we remove more Intel, that doesn't necessarily increase the expected return of our portfolio. Next, we'll be doing another simulation, this time incorporating the S&P 500 itself. We incorporate this because it has a very low VAR, and this will then this test will verify the robustness of a program in weighing low VARs and a moderate return. This is seen in the posterior distribution of mu for each stock, where we see that the S&P 500 has decent returns compared to Apple. Although it is less than Apple, it has a lot lower V risk associated with it. And so this should be seen in our optimization problem. And in the next slide, we'll see that for a lower risk of the maximum 5% um, drop in over 5 days, there is there is an optimal value of 90.91% S&P stock in our portfolio. This matches our assumptions that for lower risk tolerance, we should choose a lower VAR at the expense of return. For higher risk, we see that Apple heavily outweighs or heavily increases its um, its share of the portfolio, increasing from 0% to 49%. This indicates that for higher risk, we should have more Apple in our portfolio, which matches of our intuition. And here's all the results in a neat table. Um, so the VARs is specified to be a 5-day VAR, which means that it's the 5% return and the threshold is the values on the left column, which is the maximum tolerated returns. And again, from a brief glance at this, for the stocks of lower volatility, they'll be prioritized more if we set a maximum threshold VAR of a less negative number, where less negative in this case means less risk tolerance. For the S&P 500, for instance, is much higher at a smaller VAR, while for a more negative number, it is much lower, which means that there's other stocks that have better returns, even though there's more risk associated with that stock. And finally, we'll discuss the limitations and next steps of our project. So we noticed that the optimization process runs much longer for lower VARs. This indicates that there's fewer weights that satisfy constraints, and our model struggles to find weights that that will optimize our portfolio. This can be improved in ways that I'll discuss in a shortly. But first, I the it'll it'll most be imperative to verify the fidelity of our model. So for instance, we can attempt to replicate historical data using our posterior distributions using from the Bayesian analysis. This will indicate that our modeling is accurate and models the is able to simulate future returns with a high fidelity. Next, we also want to verify that the weights in our correlation matrix are well posed. We assume that there's little correlation between stocks in our portfolio, but that might not be the case, and more research would be important to verify this. A different prior for the correlation matrix can also be helpful, and can be used to verify the validity of our modeling. Okay, next, so a way we can optimize or change the optimization process is to incorporate the Sharpe ratio into our equations. And the Sharpe ratio, in short, is simply a return of a a ratio of the returns over the standard deviation of the portfolio. This directly correlates the risk with the returns of each stock, and this will add robustness to our optimization process rather than simply optimizing for returns with at, at a thus at a specified threshold VAR. But again, more research needs to be done before we can determine if this is the right um, equation to use in our modeling. And that's it for our presentation. Thank you all for watching, and have a good rest of your day.